Hey you guys, man, it has been a minute since I have filmed a video down here in the studio. Today I want to do a quick recap on what I've been doing over the last few months and really talk about my process, how I've been using data science, Python, machine learning, and even not machine learning, just regular old data science from a macro kind of top-down approach in order to make more money in the futures market. Back in July, I was having a really rough time. The markets were not treating me great. It was a different feel. Nothing that had worked previously was working for me. And it really started me down this path of using machine learning. And so in today's video, I want to talk about some of the tools, tips, tricks, things that I've learned in order to have my process be so good that even on days like today where the market was really kind of crappy and choppy, I'm still able to absolutely slay it. And so let's talk a little bit about that. I'm going to give you my exact approach from the top down and try to keep this as short as possible. So if we roll over here, I want to talk about what I share in YMI as a kind of a starting piece, right? Let's see if we can get a Discord open. Let's see here. Where is good old Discord? Why is it not opening? Oh, there we go. There we go. So one of the big things, if you're starting from a top-down approach, and this I posted yesterday, why is it working so much? We start out here. It says, based on where we are at this year, this tends to be a profitable time over the last 15 years. That said, we are seeing more weakness than we have traditionally seen this time of year with the greed versus fear index. This was on Sunday when I was talking about Monday. And what am I talking about? Well, I created a model, which I could go over and show you the full model. I'll show you the full model. But what I'm doing is I'm looking at the time of year, October. We are on October 24th. So if you go to October 24th and you average things out, this uses a rolling 10-day period. And then it does that averaged out over the last 15 years to find out what the average return for each day of the year does. And so you might go, well, Cameron, what does last year or the year before, the year before, the year before have to do with what we're likely going to see going into tomorrow? Well, I'll tell you exactly what. It's called seasonality, and different seasons, different periods of time, generally speaking, we can start to see trends in the data where we're more apt to have days where we look for upward movement. We might have periods where we're looking for things that are more likely to move to the downside. We can see that over the last 15 years, late September is not a favorable time for moving to the upside, right? Whereas we can look at this and go, okay, well, that same period a month later in the year, in October, we tend to see it where we're seeing many more green days occurring, and even into November versus early October. And that doesn't mean, again, if we close out the chart here, and I move this over, and this is the ES daily level. These are the daily candles on the ES. This is a Python model that I created in a Colab or Jupyter notebook. And I added some moving averages. I had the algorithm basically create support and resistance levels. Again, this is zero machine learning, but what this does is this shows us here that at this 4206 and 4236 level, we have a level of support, and we had a previous level of resistance. Now you can see how, again, these pivot levels show up here. 4634, that was a level of resistance. We have a level of resistance right here at 4548. And again, we keep going down. Now, we're using I use a top-down approach, right? I am trading intraday using intraday techniques. I'm not looking for multi-day moves. But for example, when we get to this area, in each candle, it gives the expected high, expected low, the upper bound and lower bound. And so you can see kind of almost like Bollinger Bands, but it's not exactly the Bollinger Band calculations. You can see kind of where we're expected to get some support. For example, for today, we had 4208, yesterday, 4208 was that pivot level, plus we had these other bands where that expected low was 4190. So we had some levels of support in this range. We had just been through 5 red days in a row, or 4 red days in a row. I think we might have hit the fifth. We had hit multiple days red in a row with no real bounce. We'd got to a previous level of strong support. And what did we do? We ended up running up yesterday. And today we actually finally closed higher than we opened and had our first green day now after 5 red days on the ES. Now, you could go, well, Cameron, that's easy to say in hindsight. Hindsight's always 2020. Going back to those other models, right? We can take a look at, it's one way to visualize the data, but you can also visualize the data in this aspect as well, right? You can go over here. You can see those average returns. This is, again, it's a model that I built. I share it with the group in my Discord group. But then lastly, going down here, we're going to take a look at NQ. And NQ was down here. We had support at 14,600 basically. And again, what caused me to be more likely to, expect some more support in here? Well, that we had sold off fairly strong right down into a previous level that had strong support. And this is all based on just a Python model that I created using daily candles that anyone can do. Anyone can create this. Then I took that data. I also created a heat map chart. And you can use this and it will give the following day's projected expected low, expected high, lower bound, upper bound, and then it, I don't know why that has, close of the previous day. It just dropped the close down. But you can use these, and then you can also tell whether it was within 0.25% of those one of those expected levels. And if it did, gives you a true. And this gives you a percentage over the last 10 days, how accurate that has been. And then if you want to know how many points is 0.25% of whatever, right? You want a percentage value turned into points. This tells you approximately how many points 0.25% is on the NASDAQ. So these models really helped me out. But if you want to take it a step further, let's go back to Discord and talk about what else was really important basically for today. There's the Python model. There we go. Going into today, if we were looking at, I'm going to close this out here, and we're going to go to what I posted last night. I had said down here, so where do we go? Going into tomorrow, we will likely see more upward movement. But I don't expect today, to have as wide of a range as we saw today, which was Monday, right? Expect more of an inside bar type of day, a tighter range, meaning we're not going to likely trend and move much higher like we did on Monday due to several economic numbers. We had new home sales that are coming out tomorrow on Wednesday. We have jobless claims. We have Q3 advanced GDP estimates. We have pending home sales coming out on Wednesday. And then what else do we have on Thursday? We have earnings for Tesla. We have Google, I know. We have, there's a ton. There's a lot of big tech companies that are reporting earnings. So we have a lot of earnings stuff going on. There wasn't a whole lot of stuff for today. And again, using that macro picture, not a whole lot of stuff today. So why would we see the day rip high? Not likely to. So what does that also tell you about as we move into our intraday plans and using key price levels? It tells us that we don't want to just focus on, buy and hold the entire day. Why? Because if it's inside, we're going to likely see a little bit more chop, and that's exactly what we saw. So what we do here now, we roll over here, and if we go to, let's see here, we're going to go to the charts here and look at the key price levels. So key price levels, our first move up was right to the fair value gap. This is exactly what happened yesterday when we got that move up into this red fair value gap zone previously, right? We got to it, we never filled it. And then today we got up to it again, never filled it. But we did hit the midpoint and then we pulled back down. This would have been a great opportunity, especially down here right around this target level, to take some profits off. If you're getting short anywhere up here in that 42 mid 70s range, 70 down to 50, you're talking about basically a 25-point move on the ES that you would have made. Fair value gaps, when we're talking about, important things on a daily chart and why I wouldn't just blindly trade KPLs, the simple reason for that, or for why I don't do that on a day like today when I'm expecting it to be inside of the previous day's movement, is because, again, KPLs are looking for long moves. We were not looking for long moves today because we did not expect strong trending moves. We needed to take quicker profits. That's exactly what we did. So if you're looking at now, knowing now, if we're again, we gotta like rewind, revamp a little bit and go back. What do we do now that we've taken this top-down approach and we've looked at the macro stuff? How can we make our trades on the 15-minute time series or on the 5-minute time series? How can we make them better? The way we can make them better then is using the fair value gap rules. And if we go down here and we click on this and we go down to the educational section, this is where we tie everything together on a more granular approach to things, right? So fair value gaps, we all know what they are. If you don't know what they are, watch one of my previous videos. There's a video that I talk about these 3 rules exactly. It's like maybe 1 or 2 videos old. But if a fair value gap forms in Globex of the same session, there's a very high chance we will retrace to that zone during regular trading hours, especially when it's not a major trend day, which we didn't expect today to be a major trend day. This is a slam dunk observation and highest probability rule of the 3. The fair value gap created during Globex, that is within 2 ATRs of the open price, has the greatest probability of being filled during regular trading hours if they aren't already filled in Globex. And if, again, you're going, what the freak does that mean? Well, let's go back here and take a look. So this fair value gap right here formed, we didn't have any fair value gaps, that formed during Globex. So we had no fair value gaps that formed during Globex. Now on the previous day, for rule number 1, we had this fair value gap that formed during Globex, right? This formed approximately at 2:30, 2-ish a.m. Central Standard Time. We then had another fair value gap that formed right here around 4:30 Central Time. And then what did we do once we hit the market open right here? Market open, we wick down, we bounce, we fill that first fair value gap. Then we come back up here, we fill this second fair value gap. And then we had a fair value gap from Friday. This was Friday's fair value gap that we ended up retracing to before we dropped down. So on Monday, this was a great example of rule number 1. These rules, when you wake up and you look for previous, Globex action, did we have any fair value gaps or anything that's going to help improve your trading for the following day? It's got to be looking at those fair value gaps. That's one of those really big things that help us know, are we likely to retrace and fill those, or have we already filled those during Globex? And again, this was a great example. Now, rule number 2. Let's go back to rule number 2 here and talk about this. So if a fair value gap forms between the open and 12 p.m. Central, it's likely we can retrace around 10:30 a.m. Central or 1 to 1:30 p.m. Central Time. This rule is least probable of the 3, but will still be greater than 50% depending on different factors, blah, 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 blah. You can read that, pause that if you want to check that out. But going back here, what's a great example of that? Well, we had a good example of a fair value gap. I guess this one formed, would that be that rule? Yeah, that wouldn't be rule number 2. We don't really have a rule number 2 for that retracement. Yeah, so really no rule number 2. Nothing really occurred there. Well, I take that back. This fair value gap right here, this little tiny guy, even though he's not really tiny, this one right here was a great example, right? We created this gap right here at about 10 a.m. What did we do? We come down 15-ish. We get the reversal and we come back up. I guess this one even formed at like 11 a.m. So it's still in the first half of the day. We got those created and then we came back and retraced. So rule number 2, that that works pretty darn well as well. That was a good example for today. And then we're going to talk about rule number 3. If a fair value gap forms after 12 p.m., this is after 12 p.m., and is not retraced to during the session, and it's within 1 to 2 ATRs of the closing session price, right? There's a near absolute certainty you will see the retracement right away in Globex. If that does not happen, you can still very well get that retracement in RTH. And I'll give you one last example of how that rule applies and how I'm using that. We technically, this fair value gap right here on yesterday formed at 1400 hours, right? Could you say here that, that this retraced before the session? This is when the session's over. Yes, I would consider this a retracement. And if it never filled the gap right here, I would have been fine. I would have been totally good with saying, okay, if we continue down, that counts. You hit the 50% retracement of a zone. It's not completely filled, but 50% or greater, that to me is considered a retracement. This would have validated the rule right here as we pushed up right into the end of day and then into Globex. But you could also then take it one step further and say, well, again, we have a likely chance that we'll completely close that gap out. What did we do? It was a consolidating, non-trending day. It wasn't like we were just going to continue ripping higher. We didn't think that was the case. It wasn't like we were dropping significantly the previous day and that trend wasn't even going to want to come back and retrace and touch and validate it and then go down. We knew it was more of a trend day, and that's kind of what we essentially got. We ended up getting that fill, we got it taken care of, and that's how things played out. Now, the last thing, I want to talk about that I also tend to use is these levels as well. It's another algorithm that I post on these charts every single day for you guys. These algorithmic levels really help as well. I just can't really say much more than it's a combination of multiple pieces. It's not like the market has gotten insanely easy, but it's gotten more volatile. We do better when there's greater, wider ranges, that's for sure. And we have more tools now to help us to filter maybe not filter the data. The tools don't help us filter the data. We have better tools to give us better quality data. And with that better quality data, what we are essentially able to do is filter out not using specific KPLs, not use specific KPLs at certain times of the day, and maybe not use certain sides. Maybe I'm personally not always going long and short off of both sides of the KPL. Now at the basic, framework of this, yes, that's what you do, right? But you want to filter. If you want to maximize your full potential, you want to use these tools, which I've been creating, to better your process. And I think that's really where the data science and all that stuff has really come into play. I really couldn't have done it without any of that stuff. And it's hard and it's not easy, and nothing in life is really easy if it's worthwhile, right? And I don't want to get into that whole speech, but I hope you found this video helpful. If you did, give me a like, appreciate it. If you're not subscribed already, hit the subscribe button, and we're going to continue doing really well. There's a lot of good stuff in store right now. I am so hyped, so in love with what we're doing right now, and I am pumped. So I will catch you guys in the next video. Thanks for tuning in, and catch you guys later. Bye.